Hey, it's Attorney Jeff Cooper. I want to talk to you today about the exciting topic of income taxes, right? Everybody loves that topic. Kids read about it, they just get overjoyed. So listen, here's the problem. A lot of people don't understand maybe, or don't even think about it. It's not that they don't understand it, it's that they don't contemplate the fact that income tax rates are likely going to be on the rise in the future, okay? I had a Facebook conversation with somebody the other day, and she was saying, well, prove to me that taxes are going up. I was like, wow, all right. I've talked to probably 200 clients or prospects in the last couple of years, and I ask this question every time, and invariably, well, not invariably, maybe 98% of people have the feeling that income tax rates are on the rise. Beyond that, obviously, the Tax Cut and Jobs Act is going to sunset at the end of 2025. Right, so that's January 1st, 2026. I think we have 3.5 years left, a little short of that. Income tax rates are definitely going up. I think possibly under the Inflation Reduction Act, maybe some income tax rates are going up. But somebody says, his claim is that income tax rates would basically have to double to cover all of the unfunded liabilities that we have, all the stuff that we're taking on now at this point. So it's getting a little ridiculous. In case you don't know, income tax rates have not always been, 10, 12, 22, 24, 27, 30%, 37%. They've been as high as 94% for high earners in the past, 60, 70, 80 years. So that kind of thing could certainly happen again. And what we help a lot of clients do these days is transition to as close as they can get to a kind of tax-free retirement experience. And I know it's not exactly within the realm of estate planning, but your estate plan is basically just the legal structure for how your financial life works, okay? So we want to integrate those things together. And so there's no reason to just, give people a stack of documents like, here's your will, here's your power of attorney for healthcare and finances, and then maybe there's a trust document or something, and then we just completely ignore their financial life. We have to make all of that work together. I think a lot of people are surprised to kind of look at the fact that when they have tax-deferred money, they're basically inviting the government in as a partner on that account, a partner who gets full authority to tell my client what their percentage ownership is at the time of withdrawal. Okay, so think about, I put money away in, 1999. All right. And, if tomorrow is 2022, 23 years later, if I'm going to withdraw money, the government gets to decide what their percentage ownership is of my account. And so if I'm going to grow it to 2030, 2040, 2050, if you're 35, 40 years old, you're not going to even be able to withdraw this money without penalty for another 20 years at least. What are income tax rates going to be like? And so I'm not telling you to do no investments that involve future taxation. I'm just saying, as an industry, as a profession, look, a lot of prominent people in my world, people who offer continuing legal education, people who are very well respected, and as well they should be. There's nothing wrong with that. But they're holding on to this old idea from the 80s that future taxation is the thing to do, and it's the only thing. And I just want to caution people. I just want to get the word out that, man, the circumstances have changed. This is very circumstantial. Let's say I give you the advice, hey, you got to put on like hat and gloves and a parka. Okay, well that's probably pretty good advice on January 15th, right? It's not such great advice on September 2nd. Okay, so it's the same thing with income tax considerations. You have to consider the environment that you find yourself in. If it's the early 80s and income tax rates were really high, obviously, absolutely, everything you can do to avoid current taxation and save on your taxes at that point and put them off until the future, great, because maybe they're going to get better. But today, man, we find ourselves in an environment where we have the lowest tax rates that we've seen in like 80 years, all right? And people are still putting money into these, kind of conventional, what everyone tells you to do, the 401k, the IRA, stuff like that. Again, I'm not saying don't do that. I'm saying evaluate it. I'm saying consider it with a professional, hopefully, who can help you kind of consider what else do you have going on. With respect to tax-deferred money, you just need to take an individualized, customized look at whether that's actually a good thing for you or not, okay? We have a lot of our clients who are, there's the 22%, the 24% bracket, and then it jumps, okay? So if you can fit in some of your 22% and then get a little bit under the 24% and then skip it, that's fine. We have a lot of clients on like a 3 and 4 year plan getting to 2026 with less tax deferred dollars. So estate planning lawyer Jeff Cooper, if I can help you with any of this stuff, I'd love to chat. Thanks a lot. Bye.